Hi, everybody. Thank you for joining our session today. We'll go ahead and get started. My name is Shane. I run the investor relations and events over at 10 Capital Network. We're very grateful to have Maggie Sprenger of Green Cow VC join us today to talk about how to identify a good SPAC for investment. So, with that, I'll let Hall take it from here.
Great, Shane. Thanks. And Maggie, thank you for joining us today. Looking forward to learning more about SPACs and so forth. Before we get into it, can you tell the audience a little bit about yourself and Green Cow Venture Capital?
Sure. Green Cow Venture Capital is an early stage investor. We look for companies building at the intersection of frontier technologies and foundational industries, or another way to say it is boring, under-innovated spaces with massive global markets and solutions that weren't scalable, say 3 to 5 years ago.
Great. Well, there's been a lot of talk about SPAC, special purpose acquisition companies, and just wanted to first define that and how that works for those who are not familiar with it. Can you give us a short rundown on that?
Sure. A SPAC is a way to take a company public outside of the traditional IPO route. So a SPAC is basically an envelope, an empty company that is already public that merges with an existing company to take it public through the process.
Well, we're seeing a near explosion of SPACs this year. I think they're on track for 1,000 SPACs, and we're well on their way to that. Why is there such a big demand for SPACs?
I think what we're seeing is it's a perception that it's an easier, faster way to take a company public than the traditional IPO methodology or even a direct listing. And SPACs present some opportunities that aren't necessarily prevalent in the traditional IPO methodology, which includes the value add that a SPAC team would bring to a private company trying to go public. And the other big difference is the ability to provide projections in proxy. And so to engage in direct conversations with investors over a period of time can be really helpful in clarifying a complex business. And given where a lot of technology companies are right now, I think that this has been a significant advantage.
So when you go IPO, how is that different than going SPAC? What can you do or not do? How would you contrast and compare the two?
So in a traditional IPO, it shows the baseline information of the financials and what that company is doing today. The big difference in a SPAC is that the SPAC has the opportunity to talk about these projections, right, in proxy, talk about forecasting. It's almost a way that we as VCs look at companies and that we are very focused on future earnings and growth rather than what the company is doing today. So go ahead.
Well, you said it's an easier way to raise money, but is it a cheaper way to raise money? What's the cost difference between the two?
Yeah, it's a huge difference. Trying to think of a very easy way when I don't have a whiteboard to show you behind, but if we think about two companies and their current capitalization of two private companies, each with 100 million shares, the capitalization of each of those companies today is 100% in those shares. When you raise via a SPAC for company A, they're going to be SPAC founder shares. They're going to be SPAC founder warrants. They're going to be the public shares. They're going to be the public warrants. There very well might be a PIPE investment. And all that means that at the end of that raise, those 100 million original shares of the company are now diluted to about 70% of the company's value. And the cash to the balance sheet might be 178 million. When we think about an IPO for the same initial looking company, right? Company B has 100 million shares. That's 100% of the total shares outstanding for the current capitalization. If they go through an IPO process, the IPO investors are, say, going to have 20 million new issued shares. And that's going to be 16% of the company versus a much more significant number when you're doing the SPAC. And so in all, the company B going the IPO will be diluted to only about 83% of the original valuation. And the total cash to the balance sheet is going to be north of $180 million. So SPACs are quite expensive. This is perceived as a cheaper, faster methodology to go public, and that is definitely not always the case.
Wow. And so some SPACs seem like they're doing well and some are not doing well. How would you define the SPACs today that have gone out there? Who's doing well and who's not?
I'm going to avoid naming specific companies to be protective of myself and people who might be potentially investing. But I will say that the big differentiator that I see in companies generally are the ones that have done the best in explaining where the business is today and the timeline and the effort that will be required to get it to the forward projections that it's using to raise that money. And then the other thing is, you know, like so much else in investment work, it is all about the team. It is about both the founding team of the company going public via SPAC, and it is really about the team that is taking the company public via the SPAC. Who are the, you know, who is part of that SPAC team?
And what do you look for in a SPAC team? What kind of skills or expertise do you need? What tells you that's a good one versus not?
I want to see alignment with the skills that are gapped in the company going public. So if the company is really just starting to hit the growth stage in a big way, if they're looking at international expansion and they don't necessarily have expertise in the space, but the SPAC team can provide that guidance and really bring value to that company, that's significant. I think another thing that should really be examined for past SPAC teams is the redemption as a percentage of IPO proceeds. So the redemptions in most SPACs is very, very high. And this is directly tied to the quality of the sponsor. So when SPACs have a higher quality sponsor, redemptions are still high, right? They're still going to be about 73%. But in the average SPAC, without necessarily a big name, and I don't mean big name like Alex Rodriguez, I mean a big name like Alec Gore's, redemptions can be 95%, right? So finding a team that is in it for the long haul, that is committed to seeing this company grow thoughtfully, that can add value, that's participating in the pipe. These are all things I want to see when considering how the SPAC is going to do. And I'm going to look very closely at past performance and, you know, look at the de-SPAC ownership held by all SPAC shareholders, including the sponsor, which again is very high when compared to a traditional IPO.
So if you're looking at 1,000 SPACs going public, how many quality teams and companies are out there that can execute and acquire in this market? If you had to put a number on it, it just doesn't seem like there's going to be 1,000 great opportunities. It seems like there's going to be something less. And, you know, those are the ones we want to avoid, or maybe they're the ones that raise money for a SPAC, but then have to give it back because we couldn't acquire a company. But what's your number on that?
I don't have a number, but what I will say is to do a comparison of the number of companies that were going public in a traditional looking market versus the number of companies that are trying to go public in this current land rush of SPACs. Going public is really onerous. It asks a lot of companies. There are new regulatory hurdles. There's a level of accounting that might not have been as stringent and as consistent as what was done in the days of the early startup. You know, there are reporting requirements, there are analyst calls, on and on and on. It is very time consuming and it's expensive to be a public company. And so to be able to do that thoughtfully mandates a certain maturity in the company in terms of both headcount, availability, bandwidth, expertise, know-how, capital, that I think is not being as carefully considered in every SPAC opportunity these days because of this feeling that you know, the sponsors can make so much money. And if the sponsors aren't interested in the long-term success and longevity of the acquired company, then there's a real misalignment around goals and considerations that I find deeply problematic. That said, I think that there are certain categories that present really significant opportunities. And there are others, but my favorite spaces are the ones that are hardware focused, or that are inventing a new category. And so I would say that there are a lot of deep tech and frontier technology companies that have massive capital requirements because of what they're building, how they're building, the number of years it will take to build it, right? When we talk about robotic systems, the software systems alone can take years and millions of dollars to develop, let alone the hardware side and the implementation and the development and rollout of the prototypes and the manufacturing. So all that is to say, there are some compelling reasons for some of these somewhat younger tech companies to be going public if there is compelling use of the capital expenditure. It does beg the question of why not stay public or private longer if there's justification around those business activities, because public is, so difficult and so much more to manage. But that is generally the argument of why do we see some of these younger tech companies going public? And the answer often is because the capital requirements for this type of work is significant enough to merit the ongoing, demands of the activity.
Cool. So many companies avoided going IPO because of the Sarbanes-Oxley, the regulatory that you talked about. If someone goes SPAC, are they also under the same Sarbanes-Oxley? And so there's really no difference there one way or the other. You end up in the same place.
You do. You're still a public company. The merger means that both companies are then public and now under one umbrella.
It seemed like the IPO process was set up to help people transition, or companies transition from private to public, quarterly reporting, compliance, and so forth. And it seemed like that was part of the process. Maybe it is or it is not. But in SPACs, is there a similar process that gets a company in a place where they can start to meet those regulatory requirements, or is there a difference between the two?
It's good. So the investment banks have a flat fee and a very methodical approach to, here is what you're going to need to expect. Here is how we're going to think about it. Here is what this looks like. The banks want this to be a success. So do the sponsors of the SPACs, but the banks, it's more systematic. Whereas for the SPACs, again, it's the quality of that sponsor team and whether they are seeking a quick redemption or looking to hold the stock for a longer period of time.
Great. Well, if anybody in the audience has a question, please drop it in the chat box and we'll continue here as we have. So if somebody wants to invest in a SPAC, you look at the team, you look at the redemption, you look at the quality of the company that's going public and so forth. What else would you put out there as I think some PACs are doing well and some are not doing so well right now. And what other characteristics might be at play there?
I think looking at the underlying business itself and whether you think that this is something worth holding for years. I'm not a big fan of the quick flip on buying an equity. I think if you're not interested in holding this for some years, it's probably not the right play. Otherwise, you're sitting on volatility and hoping for that to be the driving force. If you're looking at the fundamentals of the company itself, and I do think that we are very much in a time period when fundamentals have been significantly overlooked, as well as the future use case of the technology, the way the team can grow, future markets, future applications. Those are the things that I would look at.
You think SPACs will continue at the same pace, or I think they're already slowing down, but how do you think we'll end up at the end of the year? Do you think we'll hit the 1,000 number, or do you think we'll fall short?
I don't know, but I do know that there is a lot of increased regulatory scrutiny around SPACs and who should be sponsoring them, how casually they've been taken to market in the past. And so as we see regulatory interest and oversight increase, and as I think that there is increased understanding that the number of companies that are really SPAC worthy or really ready to be public entities, right? Those have decreased. You have inverted forces in this space. And so the number of companies out there that are actually good candidates to be public companies is pretty finite. I don't think that we can just see this ongoing land rush because it's not tied to quality.
Well, the other option for going public is Reg A plus, and do you see any movement there, or you think that's a good option for some people to consider?
I honestly haven't been paying attention enough to it to consider it. It's not something that any of my startups have looked at in the past.
It seems like it's very new. It's a path for the Title III companies to go up in public itself. We've worked with some so far, and it seems like it's also an alternative path to the public market. I think many of the same rules apply. It has to be a good company, it has to be a good team, or it won't make it. But it, I think, gives the Title III crowdfunding a path out into the market because they seem to be having a parallel path from the rest of us as far as valuations and other metrics that we normally use in this case. So it's something we're all trying to consider. But getting back to SPACs, do you think they're going to be here for the long haul? You think it's going to be a substantial part of the opportunity going forward? Or do you think it's going to shrink back down to what it was?
I don't know that it'll ever be as small as it was. I think it was very much in the shadows for a long period of time. And the reality is there are some compelling reasons to leverage a SPAC, right? Not only do you have, if you're partnering with a quality SPAC team, you can have significant value add from a private company that can really aid this new company going public. I think people do like the price discovery that occurs before the transaction announcement. I think that's compelling in a way that IPO tends to be less transparent. I think that because you can potentially raise more capital than in an IPO, and you can help pull forward over-levered businesses or sponsor monetization, that aspect is going to continue to be compelling. And, you know, a SPAC can deliver a blue chip shareholder base. So as long as those are still in play, I think SPACs will continue to be an option. That said, the high cost of SPACs due to the sponsor promote and the warrant dilutions and the fees, I think that means that more companies will consider a direct listing or an IPO when they feel like they have more options, and the optionality and the choice around it is going to mean that SPACs have to figure out how to increase their value add to a company. And I also think, you know, that the one thing to be really cautious of around SPACs is that the headline valuation is not necessarily indicative of the true equity value due to dilution. And that's something that I think people need to be very cognizant of when considering a SPAC, alongside that capital risk due to the redemption.
What kind of range of dilution have you seen so far?
I told you there's that Stanford study that I think went on between early 2019 and the first half of 2020, and they were seeing redemption up to 90+%, which is just wild. I mean, you know, that so clearly shows that this is meant to be a momentary flip, not an investment in a long-term position.
I remember IPOs at one point were very much market driven or season driven. You had to have the right time, you had the right market before you would actually run an IPO. Many companies would go down the path of starting an IPO, but then the market conditions weren't just ideal. And it just seemed like it was just a very sensitive issue for going out with an IPO because so much was riding on it. Do you see the same timing issues coming up for SPACs, or you think SPACs are a little bit more, you can do it anytime? You're not so dependent upon the market conditions for accepting the go-to-market price and so forth.
Again, it's that very, B school answer of it depends. But I think that a high quality sponsor can definitely rally the types of investors who can come quickly to the table and say, let's capitalize this. This is exciting. There's a reason for this company to go public. And so less sensitive there. And because it's been such a hot topic, I think that there is a lot of capital seeking SPAC opportunities.
Well, many companies complain about the IPO process, the traditional one. You have to go through key banks. They would play the pump and dump game, trying to get the price way up, and then it would fall afterwards. And it just seemed like that was a bit artificial. Do you think SPACs eliminates any of that? And do you think it makes it any more realistic?
No, I don't. I think the churn and the redemption cause the same kind of problems that we've seen in IPO markets. So no, I don't think that there's a seamless way. I think as long as there is the public sales aspect of this process of going public via any methodology, we're going to see a lot of hype and promotion and, push for enthusiasm, because the goal is to sell the company. The goal is to raise the capital, and that's done through sales techniques, and that is simply part of going public.
And we saw some using direct listing at some point. How does SPACs compare to that? Is there any advantage of a SPAC over direct listing, or vice versa?
I think the biggest advantage in a SPAC methodology versus a direct listing is the ability to leverage that sponsor team and that network.
Okay, great. Well, in the last few minutes that we have here, what else would you like to add about SPACs and what you're seeing out there in the marketplace?
As exciting as SPACs have been over the last 24 months, I think there's actually never been a better time to be involved in the very early stage of companies. I think what we're seeing right now in terms of opportunity and creation, from space to, again, what I focus on, very boring methodologies that are attacking scarcities or inefficiencies in global markets with these frontier technologies, it's thrilling. So I will continue to focus the vast majority of my effort on early stage companies.
Great. Can you wrap up and tell us a little bit more about Green Cow Venture Capital and what you guys do there? More
Sure.
detail.
We just wrapped Fund 1, actually. It came on the heels of Bear Flag Robotics acquisition by John Deere for $250 million. This was actually really interesting because as a hardware company, they had only raised $12.5 million. And the company sold when it was 4 years old, I think. Fund 1 is posting good returns, 2.5x MOIC, 71% IRR. We're punting up Fund 2 right now. And yeah, it's exciting.
Great. And for those in the audience or those who listen to the recording, what's the best way for them to reach you?
LinkedIn is always an option, but sorry, I'm just looking at, there we go. Maggie, Maggie at greencow.vc, as in venture capital.
Well, great. And so one of the questions was, are you available to early stage founders? And it sounds like you are. So LinkedIn's the best way to do that.
I do, Brian. Feel free to reach out.
Any other questions before we wrap up, guys, today? We'll give them a moment or two. Want to thank you for joining us today, Maggie, and sharing the information with us. We see a lot going on with SPACs. There's a lot of activity in the marketplace today. Sound like you guys are having great success there as well with your fund, and congratulations on that.
Thank you. And I don't mean to sound too dour about SPACs. I simply, at the end of the day, I'm a founder first person, and I think that it can be a fraught landscape if it's not done correctly. And there are a lot of voices in that space right now that are not doing it correctly. The flip side is, an LP in my fund is Alec Gores, and I think he's done an extraordinary job taking companies like Luminar and Matterport public. And so again, it's very much correlated to the quality of the sponsor.
Great. Well, and thank you for joining today and sharing your information and wisdom with the group. And I want to thank the audience for coming in and the questions you asked, and appreciate everybody's time. We'll go and close it now. We will make a recording available later for those who want to use it and share it. So appreciate the time you have today, guys, and we'll go and close it here. Thanks.
Thanks for having me.